you've been one of the biggest bulls in India, but here we are, the market experiencing one of its worst times in about 3 decades. How can you remain upbeat about the Indian market?
Yeah, hi, good morning. Actually, when you talk about 3 decades, I think this is the 4th time market is in a major correction, or you can say even mini crash kind of situation. We saw it in first big one was 60% correction in 92, then 50% correction in 2000, another 50-60% correction in 2008, and recently in COVID we had 30-35% correction. So I would say this is not as severe as GFC 2008 and all, but more recently what we saw in COVID. It is that kind of a correction. It's geopolitical. I mean, nobody knows what is going to be the length and extent of this global damage. But I think the markets have responded, and at least Indian market, which has become a little more expensive in recent past, has become kind of a little more fairly valued, I would say, at current prices of about 23,000 around Nifty. We are reasonably priced. Year on year, we are still flat. 12 months basis, we are not gone any lower. So I would think that, yes, there could be some more correction, but we have now clearly reached investable point. I would say market is very fairly valued right now.
Raamdeo, what would you be buying? What's looking attractive then?
Now values are all over. I mean, it depends on what's your view on India and what you would like to be. Banks are very prominent here. They're largest profit contributor to the Nifty, and they are in last 40 years they were never in this kind of shape, and they are growing at about 14-15% at an aggregate level. But there are banks which are growing at 25-30%, and they are available at less than 1-time growth. So the peg is less than 1. Balance sheet is clean. Net NPA cycle is also kind of at their best. So I would think that you should start with the bank, and then your whole lot of automotive is the one which is seeing massive resurgence. So there are sector after sector, and the main point is that now the broad market is kind of reasonably priced. Growth is all over there because we are growing at about 7.5-8%. So the corporate earnings growth are going to be about anywhere between 10-12% for the next 12 months. So yes, we have challenging spot in tech, which was one of the darling of the market. So that's the one thing which I have no idea whether AI looks to be in the short run a headwind, but in the long run, I think they are the guys who are going to deliver AI solutions to all the corporates all over the world. So I would think that they have long-term future. Short-term, there are some challenges.
So you're saying that the Indian software companies, that sell-off is overdone?
Not overdone, I would say, but it is done in the sense that one round of I mean, if you see long-term averages, if we are available at 20 P, our earnings are still looking good despite this war. I mean, yes, it has done some damage, but I still don't think that earnings it will get some hit. But say if it was growing at 12%, it might come to 7-8%. That's the situation right now. But if things really go to $150 or something like that, I don't think market needs to correct even more.
A lot of these software companies have operations overseas, and they will be impacted by the currency. The Indian rupee today marking yet another record low, breaching 93. It is at 93 for the first time ever. How do you think, the weakness in the currency will factor into the outlook for these companies?
Yes. So this currency thing is a double-edged sword. I mean, for the exporters, it is a kind of a boon, and for importers, it's a big challenge. So we have very large importers, and all kinds of supply chain is into the global markets, and hence even domestic consumption has the impact of currency devaluation. So I think it will be inflationary, and to that extent, even corporate profits will be challenged in the short run. But one is hoping that this entire this geopolitical crisis is somewhat more temporary in character. Maybe it may last for 3-4 months. That's the belief in the market. But if actually goes and stays at $125+, I think we have to rethink entire corporate profits, how the inflation goes, how the corporate profits build up, who are the winners, who are the losers. I mean, that's a different calculation altogether.
Raamdeo, hi, this is Menaka in the Mumbai office. Since we're talking sectors, I wanted to get your view on banking. I know you just expressed a fairly positive view on banking, but what's your take on what went down with HDFC Bank yesterday and that sudden exit of its chairman?
Yeah, it's as surprising. This is supposed to be the best governed bank, actually. And they're the people who set the standards in the market. Banking valuation starts from HDFC Bank. So clearly, particularly for private sector, they were the kind of a torchbearer. And now this chairman resigning, and there is no explicit, even with the con call and all, we were trying to figure out what actually happened. So I don't think in public the knowledge is that much. It's very unfortunate what happened. The bank has been passing through some kind of a challenge after the merger of HDFC and HDFC Bank and transition. I think the bigger problem is the leadership transition from Aditya Puri and his team to the new set of people, and that too at the time when the merger and all these complications there. So I think this is a phase in which the brilliant institution available today, large unpopular company, I would say. I would think that the way Indian economy is likely to grow at 7-8%, I think there'll be fair share for HDFC Bank to perform, particularly if there is no managerial problem, in the sense that there's no problem with the governance, there's no problem with the balance sheet, P&L, NPA. Those are typical things in a lender's book you would like to you suspect in this kind of situation. But I'm hoping that this credibility of the top management is restored very quickly. But you can get these banks at 15, 16 multiples. I talk about last 12 months at this point of time. So I would think that I would be batting for HDFC Bank rather than going against.
All right. I think the other two sectors I wanted to talk to you about were consumption and infrastructure. There is concern now that there was already a very moderate recovery, and through energy prices, inflation might pose a new headwind for consumption. Again, a set of stocks reasonably overvalued or expensive, some might say. How do you view that?
Yeah, the consumption pickup. See, whatever consumption was interest sensitive, like things like automotive, it came back like the very moment, like in September, they gave the GST cut from 28 to 18, which is, I would think, India is one of the biggest tax reform or tax giveaway in my knowledge. So it was across the board, and the impact of that is very clearly visible in the pickup in the consumption. Automotives are growing almost at 25% in volume terms. So you look at the insurance, where they have cut the GST from 18 to 0%. There, the growth is more like 35-40%. So I think there are a lot of resurgence in this thing, and this is still a market which is growing at about 9-10%, 11% in terms of nominal, 7-8% real, and there are sectors which are growing at least 1.5-2 times of the GDP growth rate. So there is a lot of opportunity for corporates to invest, and well-managed corporates will be able to grow at about their earnings at about 15%. So as the index has corrected to 20%, 20 times multiple, I would think that these are times when the value seekers, those who have the value style of investing, for them it's a terrific time to start building the portfolio and have some patience for the bottoms to be formed.
Raamdeo, on consumption, do you feel like the GST gains that might have accrued to the sector will now get neutralized by whatever energy pass-through we may see over the next few months in terms of inflation, making it tougher for any kind of uptake in sales to sort of sustain over a period of time?
Clearly, Menka, the supply chain cost increase. Everywhere that packaging, the transport, the logistic cost, everything goes up, and it starts building up N-1, N-2, N-3, and finally it comes to the consumer. So clearly government is trying to take as much blow as possible by not transferring it in the fuel prices and things like that. But industrial side, I don't think government can do anything. It will be mark to market. And if the war gets prolonged, then clearly it will take away the lot of benefits of tax concession which has been given in September. So yes, you're right on that count.
I also want to ask about your continuing interest in infrastructure. It has been a vibrant sector over the last few years, but again here, commodity inflation passing through to companies like cement or sectors like cement, and also an element of maybe overvaluation playing out there. Are you still significantly bullish on infrastructure?
Yeah, long term, the gap between India and the rest of the world is the infrastructure. So infrastructure spend will be as big as what government can afford with the tax collections. So I think as a tax collection is going to be more like 12 to 14% compounded on local currency terms, I think we'll keep seeing more than fair share of money going to the infrastructure. So you have to be bullish on infrastructure for many decades to come. Forget about next year or something like that. But the short-term challenge of the inflationary pressure coming because of this geopolitical situation, that's what allows you to buy the stocks at low prices. I mean, at more lower prices, like say L&T or some other stock, they're down 20-30%. I think they have more than more than taken care of the current challenge on the external front. But I mean, I'm saying that it has probably priced for $110, $115 of oil. But if it were to go to 125, 130, I think we don't know. I mean, how much more it will damage to the earnings.
Raamdeo, you talk about infrastructure. India increasingly wants to be an AI hub. How do you play that AI ambition in India through infrastructure plays?
Yeah, so I think in India we don't have direct play on technology. We are more user and user of the AI and for individual, for the corporates and for the clients. So I think there is no direct play on AI in India as far as I know. There are small companies most of them are unlisted space. But what I see is that a lot of finance banks, they are saying that their credit costs, I mean the way they one of the companies where we have invested is a digital lending company. So they are able to use. First thing is the cost of the technology is coming down. Second, they're becoming far more smarter in lending. So the credit cost, which was say 3%, that would come down to 2% with the help of AI. So the AI is being used here in India as a much more smartly than actually providing AI as a technology to the world. So that's a fundamental gap. So we'll be slow to use. I mean, actually we'll be fast to adopt, but it will be visible in the cost and the earnings as we go forward.
Raamdeo, you're renowned for identifying 100 beggars. I'm just wondering, could you share with us which companies actually have the DNA?
Yeah, so that's what I'm saying, that if you see the next 15, 20 years at least, I mean, for compounding you need for a big compounders, you need few decades, not years. So if you see 2 decades or 2.5 decades of India, we are going to go from, say, $4 trillion of GDP now to more like 16, 17, $20 trillion by 2042 or 45. And in that phase, it's one of the most compounded economies. That's what I think one has to understand when one compares one with Korea or Hang Seng or many other regional markets, emerging markets. This is one very smooth 7-8% growing economy, and you can compound it into next 20, 30 years because per capita GDP is still less than $3,000. So even to catch up with the global average of 10, 12,000, 14,000, I think that will require more like 25 years of 7-8% of growth. So what is required to grow at 7-8%, that's all in place, and we have demonstrated that we grow it like that. So like banks, I mean, you cannot grow any economy without having a growth rate of plus 3-4% to the nominal GDP. If nominal GDP is growing at about 11%, you are talking about 13 to 14, 15% compounded growth in the credit, and hence you'll get a lot of lenders, small, mid, large. And in EIB era, even large lenders, they can grow at about 15-17%, and the stocks can grow at about 20-22%. But if you buy a mid-sized successful lender, I think it can grow at 25-30%. So that's the kind of opportunity. If you can do stocks you can grow your stock at 25% for 20 years, you're talking about 100 bagger. So that's the kind of possibilities there. We don't have to break our head to find some completely unknown, unearning kind of a situation. There are simple things available in the marketplace.
Sure. Raamdeo, I have a quick final question to continue with Haslinda's theme on style of investing. You're a value investor. Are prices looking attractive enough for you right now to jump in, both hands, both feet, maybe even with some leverage? Or are you expecting that there could be more downside to these prices? The median constituent data from Bloomberg Intelligence finds is at about 35% cut, which is lower than previous falls. So I'm just curious, are you waiting for prices to fall further before you're all in, or is this a good time?
Menka, one of the things is that I'm always all in. So that's the thing. But right now, actually, when I'm meeting the companies, I meet about 4-5 companies every day on one count or other. I'm actually finding values. Yesterday, I came across a company which is actually growing at 25%, but available at 12p multiple TTM. So, the guy doesn't know whether he should pay dividend or not. That kind of company, and good size. So I'm seeing values emerging in the market, and that's a good sign for the markets to bottom out. I mean, who knows the bottom? I mean, only fools and liars know the bottom. So I would not bet too much on whether when the market is going to go to bottom. It has corrected very well. The economy is on the upswing. Earnings are on the upswing. Yes, we have a global challenge. Okay, we'll have 6 more months of patience. I mean, I buy at 100 and it goes to 90 or 80. That's fine. But I'm buying a deep value, and my deep value is valuation below growth rates. I mean, if the growth rates of the company demonstrated and likely is about 20%, 25%, if I can get it anywhere between 15 to 20, 25p, I think I'm pretty happy.